Look, there's an old saying that a recession is when your neighbor loses his job and a depression is when you lose your job. And the reality is we haven't had the big job losses yet. It's starting. We can start to see it in the number of open recs are getting closed. And then there were those job loss numbers that just came out, which were a little higher than expected. So the job losses are starting. But so far, it's really been the step prior to that, which is people are seeing their 401ks get destroyed, stock market's down. They're seeing their wages get destroyed by inflation, food and gas prices being much higher. So there's a really good reason why sentiment is so negative out there. People feel poorer than they were before. And this could get worse, like you're saying, Jason, with their nest egg in their homes getting hit. I agree. That's the next shoe to drop, just like the commercial real estate is the next shoe to drop.
In a recent episode of the All In podcast, Chamath Palihapitiya, David Sachs, David Friedberg, and Jason Calacanis discuss the current state of the U.S. economy and what is coming for consumers and investors. Sachs, an investor in internet technology firms, speaks at length about job losses, which he describes as one of the preceding stages before an economy falls into a recession, and if things worsen, a depression. As a result of plummeting prices in the stock market, we've seen a lot of layoffs in many sectors, especially among tech firms. According to reports, American multinational technology corporation Microsoft has become the first big tech company to lay off a percentage of its huge workforce. Twitter, Google, Tesla, Snap, Uber, Spotify, Oracle, Intel, and many other big firms are either laying off workers or slowing down hiring, citing economic concerns. Despite these ominous signs, Chamath and others at the All In podcast are certain that Americans are not very prepared for what is coming. They note that many people are still spending despite the rising prices, partly because this is our first real summer since 2020. In addition, people still have some part of their stimulus checks saved up. When that runs dry, many would be hit with a very harsh reality. We will now take you to this enlightening episode of the podcast as the crew discusses their macro outlook, layoffs, and the next direction of the economy. Please watch, like, and share this video. You can also help us grow the channel when you drop your comments below. Like this video and subscribe to the channel. Thanks and enjoy the video.
I think the really big question over the next 6 months is what sort of job losses do we see? Because that really is going to be the big determinant of how hard this recession hits.
If you take a big step back to the day before the lockdowns started, we had a normal functioning economy that was growing by, call it, 2% a year. And the minute that we enforced these lockdowns, I actually think what we did was we started a supply side recession. It's what Sachs said earlier. So what does that mean? Let's just say you're a factory and you make wheels. Okay, just make something really simple. You were growing at 2% a year. Everything seemed hunky-dory. You had employees. It was fine. You used to sell your products, make 10, 15% profits. Everything was fine. And then the day after, the government said, you need to shut your factory down because we can't have people spending too much time close together because we need to get a handle on this pandemic. Okay, so you shut it down. And then for the next 12 or 18 months, what happens? That stuff sits idle. These people that used to work for you get $2.5 trillion put into their bank accounts. They spend their time doing other things. And then all of a sudden people say, okay, it's time to start the factory up again. People want to buy wheels. And now all of a sudden you find that because everything all around the world was shut down, there's no rubber to make the wheels. There's no steel to make the axle. There's no people to put them all together. And so what happens? Well, prices go up because, again, you gave everybody else $2.5 trillion. So they're like, well, I used to pay $1 for your wheel. I'm willing to pay you $2 now. Just make the wheel. Give it to me before you give it to somebody else. So that is like the classic definition of a supply side recession. And the Fed basically confirmed this in the minutes that they just released today. Jason, can you just read the quote that you had in the notes?
Well, the one up top, a significant risk that elevated inflation should become entrenched if the public begins to question their resolve.
I think the point is that, we were kind of in a supply side recession, and now by raising rates to some crazy amount, the end of which we're still not sure about, may actually then trigger the demand destruction to have a demand side recession. And so I don't know that we've lived in a modern point in time where both things have been true. Right? There's been a principle of macroeconomics that everybody's always kind of debating, is this a supply side issue? Is it a demand side issue? We know that in COVID, it was a supply side issue. We took all the supply out of the market. And now we're trying to figure out when we exhaust, all of the money we've given people and we destroy demand and take the incentives for demand to go away, right? Consumer confidence is now starting to turn. What happens then? Well, we're going to figure that out in the next 6 or 9 months. But the thing is, you have both that are true. It's not as if the supply side of the economy has been fixed. It's not as if everybody is running at 100% capacity. It's not as if all the supply chain issues have been worked out.
The Conference Board Consumer Confidence Index decreased in June, following a decline in May. It fell to 98.7 from 103.2 in May, the lowest level since February 2021, when it fell to 95.2. The Present Situation Index, which indicates consumers' assessment of the current business and labor market conditions, fell to 147.1. On the other hand, the Expectations Index, which shows consumers' short-term outlook for income, business, and labor market conditions, is much lower at 66.4, a sharp decline from 73.7. In May, the index is currently at its lowest level since March 2013. Please listen to the crew's analysis of the situation.
It seems to me like this is sort of akin to what Sachs was relaying about that founder at the Co2 conference, which is like, he thinks everybody else is going to, roll up their sleeves and buckle down, but he has no intention of doing it. I think people are roughly the same way. And I think their behavior is, well, if things are going to get hard, I'll deal with it in the future. But right now I have money in my pocket. And, if you look at airlines and how many people are trying to travel, if you just look at like the cost of a hotel room, if you look at what's happening this summer, it does not seem like people are slowing down or tapping the brakes in any way.
Yeah.
This is where I get concerned about credit, because it's not coming from wage gains. The increased cost is there. The increased income is not. And, we're seeing continued month after month increases in consumer credit balances. And that, I think, this was the point I made a few episodes ago, was I don't think people are going to slow down how they're living and how they're spending.
It's exactly what the data is showing.
There's an inertia. There's
Actually,
a lifestyle
I don't know
inertia.
about that. I don't know.
Well, I just think after 2 years of a lockdown, I do think that people are anxious to reestablish some amount of normalcy. And this is really the first summer where everybody writ large can be out and do the things that they were planning on doing.
Last year was the head fake summer, yeah.
Last year was a little bit of a head fake. And look, you have 2 years of pent-up plans of,
Weddings.
50th anniversaries and weddings and all of this stuff that's happening. Yeah. And so I think people are really spending money. Like, I think that we have been in a supply side recession. That is what has caused inflation. We have to go through a process of taking all the excess money that's been put in out. And when you do that, we will destroy demand, and then that'll trigger a demand side recession, because people
will destroy asset values.
And we will destroy asset values. So
we started that process. Asset values went real quick. Yeah.
That will happen second.
So the balance sheets of that segment of the population that is overspending right now, once their balance sheets really take the hit and they take a hard look at what their savings are, they're going to cut spending.
Right.
Yeah,
So, but the point is, I think we're still firmly in that first phase, and I hate to be the bearer of bad news, but the reason why I think that we're still in the first part of this process is because people, broadly speaking, still have a lot of savings because of all the stimulus checks. There is still a lot of money. So how will we know, maybe is the better point, when all of that excess savings has been, torn away from these people because of high prices? I suspect it's when Jason's first chart starts to close, right? So when people are, they're more motivated to re-enter the workforce. I think that's a signal. Freeberg, your signal is another one, which is when credit delinquencies really start to spike. It's because people then, tapped out their savings, then they tap their credit cards, and then all of a sudden they become delinquent. When all of those things happen, you're probably now at a point where that first phase of the supply side issues are largely done, and now you get to the demand destruction. But all of those roads, unfortunately, lead to the same conclusion, which is like, equities get really under pressure. There is no scenario where there's a bid to equities. Why would you buy something that has lower earnings in the future? Or why would you buy something that has a lower discount rate for profits in the future? In this case, both are true.
Chamath, Sachs, and Freeberg are not the only ones warning American investors about what the coming months may look like. On Thursday, JP Morgan CEO Jamie Dimon rattled off similar warnings during an interview. While Dimon acknowledges that consumer spending and their ability to spend remain healthy, he also warned that geopolitical tension, high inflation, waning consumer confidence, the uncertainty about how high rates have to go, and the quantitative tightening and its effects on global liquidity combined with the war in Ukraine and its harmful effect on global energy and food prices, are very likely to have negative consequences on the global economy sometime down the road. With market experts sounding off warnings about the economy, we believe more investors will look towards the cryptocurrency space to avoid the impending collapse. Despite the 9.1% consumer price index for June, Bitcoin has been performing beyond expectations, gaining over 3% on Wednesday and over 1% on Thursday. As of press time, the world's largest cryptocurrency is trading at $20,786. What do you think? Is this another short reprieve for Bitcoin? Or is this a final decoupling from the stock market, which has not shown similar signs of recovery? Please drop your comments and observations below, and don't forget to hit the like button. Thanks for watching.